There is too much of information out there, right? We are bombarded by information 24/7.
Today's markets, it's more prevalent than ever as well.
Property is one of the most common wealth building tools in Australia, but not every property builds wealth.
It really comes down to looking at what that purchase price and value proposition was at the time.
This isn't an isolated case. It's a pattern in certain high density pockets, right?
You know, the most important thing is buying property well. From day one, the better you buy it, the quicker you're going to make growth.
Two investors buying at a similar price point around similar timelines, but their outcome can be more different. So when you look at where the Australian property market is today, it's fascinating, right? Prices are holding firm, demand hasn't really slowed down, and yet you'll still have a large chunk of buyers sitting on the sidelines waiting for things to settle down, right? Yeah. What we are noticing is that it's not a question of when to buy anymore. It's about how to buy the property right? Because in any market, there are people who win and there are people who get stuck. And the difference almost always comes down to having the right strategy, the right structure, and the right support behind you, right? Now, mate, we were chatting about this the other day, right? How in today's market, information isn't the problem. In fact, there is too much of information out there, right? We are bombarded by information 24/7, and everyone's got an opinion, but very few people have a framework, right? And that's what I really want to unpack today. Why FPW was created, what gaps you saw in the industry, and how real investors can avoid making the mistake that's still happening right now, right? Mate, you've been in the finance and property space for almost like more than a decade, actually, right? You have seen markets rise, fall, flatten, and repeat. So what was the real motivation behind starting the FPW group? Because what we are doing here isn't just another brokerage firm or buyer's agency, right? It's much more integrated model.
Yeah, definitely. Look, from obviously being in the industry for quite some time, originally my core focus was around the mortgage broking part of property. I built up a number of years in the mortgage broking space. I soon then sort of went out and tried to get an understanding in the mechanics of the property market, getting exposure in property development, real estate, construction, sort of understanding all the mechanics and moving parts there. And I soon noticed that a lot of people weren't really making, not that they didn't have the right information, they probably had an overload of information, but also trying to work out what's important and what's not, and understanding all the ins and outs of income and expenses and especially taxation and cash flow. That was what a lot of people, I believe, were holding them back from making the jump and purchasing an investment property. And that's why coming up to nearly 7 years ago, we started FPW Group, and that was really to help people gather the right team around them. Like we have obviously the finance side, the mortgage broking, we have the buyer's agency and property investment acquisition side to the business. And we've also built a property management team to help get the right information and have a proactive team looking after your property. To add on to that, we've also built relationships with solicitors and conveyancers, accountants, financial planners, tax depreciation specialists, to name a few. And that was really around getting the right advice from the right people in a timely manner to pull that together all in one place. So it's really easy to obviously digest that information, but make a decision based on figures and numbers that fit your personal circumstances rather than buying for the sake of buying. Each one of those professionals and that team really make a difference in getting the right results, because as we mentioned before, like it's not just about buying, or it's also about trying to find the property that has the right value, using professionals which are on your side to work towards the common goal. You know, it's similar as like a sporting team or something. When you've got everyone moving in the right direction and towards winning the same game, you obviously get a better result than everyone running in different directions. I think in today's markets, it's more prevalent than ever as well, because the market is running at a very high speed.
Yeah.
and having everyone ready and prepared and having access to the right information quickly can help you make a better decision and find a property which is obviously of good value and fits your circumstances.
100%, yeah. And that's exactly what most people kind of really miss in these days, right? Because today, as I was just saying, that the challenge isn't a lack of information. It actually is the opposite, right? Everyone's got an access to the data, calculators, for example, suburb reports, and there are plenty of videos available on the YouTube, right? But the problem is very few people know how to sort of read that information in a way that fits their situation, right? And that's the real risk, right? If your structure is off, or if your borrowing strategy is off, or if your asset selection is off, you are not giving yourself a fair shot. You are just adding another transaction to your life, right? And we see this every single week, right? People come to us with existing loans and existing investment properties, thinking the solution is simply to sort of refinance or buy another investment property, which is new. But without a strategy and without the right people backing you, you can easily sort of lose years just trying to sort of fix the decision that wasn't set up properly in the first place, right? And the reason I'm bringing this up is because, mate, you shared a few examples with me last week that really highlight how important this is, right? Because property is one of the most common wealth building tools in Australia, but not every property builds wealth, right? Some go sideways for years and some even go backwards, right? And that's what I really want to talk about now. Parramatta case you shared with me honestly kind of really shocked me. A unit bought for about $815,000 in 2016, selling for around $716 today, almost $100,000 hit straight away, right? But when you add stamp duty, strata, rates, and cost and inflation, the loss isn't $100,000, it's closer to $150,000, right? And this wasn't a rundown property in the middle of nowhere. It's got good location, amenities, infrastructure, everything investors assume will protect them, right? Yet after 9 years, it's gone backwards, right? So my question to you is, okay, why does this still happen in mature markets like Sydney and Melbourne? What's causing this property to stagnate while others double in value?
Yeah, look, it's a very interesting question, because I do think in Australia sometimes, property can be a little bit glorified. Like you said, I think it's some people have the assumption that everything's going to go up in value. Obviously, I always preface this with, we don't know the exact ins and outs of the transaction, but there's probably two main elements I'd look at there. One is the purchase side, and then obviously the sales side. When I say the purchase side, it really looks at understanding what was happening in that particular area. There's two sort of elements to that. That really comes down to the type of property and what the value of that type of property was at the time. So, it could be a case that the apartment might have been purchased off the plan. So that is obviously, there are some pros and cons in that purchase. Some people have made some serious equity uplift in off the plan, but sometimes there's also the flip side of that, where a number in that area, there's a huge amount of supply of a particular type of asset, which does happen in some markets when it comes to apartments. So I think there's not only the side where the first analysis would be looking at what the value of that type of unit was at the time, whether it was overpriced for what that purchase was, and there's also that can typically slow your growth over time, where basically when you've got a number of units coming to the market and quite consistently, it does obviously flood or turn the tap of supply on. And although it is in a good area and has access to transport and amenities and things like that, it really comes down to looking at what that purchase price and value proposition was at the time, and what the value of that was on the sales side. So, there is a lot of risks around off the plan in some cases, but it would really be could be a case of oversupply of that asset type. And then, there are also some further mechanics, which is why, particularly in property investment, really understanding what the cash flow is. Typically there could be high body corporates, interest costs, property management fees and stuff that go on top of that, which could cause that particular asset type in that area to be quite a bit out of pocket costs on a weekly basis, which could have been a challenge if that was an investment and it was being held for that period of time as well.
Just to sort of add my view on this as well, I think a big part of the problem is that many investors rely too much on the surface level story, right? They look at the suburb name, the amenities and the lifestyle, but long-term growth really comes from the scarcity, right? Properties that are double had constrained supply and the strong owner-occupier demand, right? And the ones that went nowhere, for example, this Parramatta unit, are markets where the supply can increase endlessly, right? And when the supply is unlimited, capital growth kind of becomes very limited, right? So for me, this is less about picking the wrong suburb and more about understanding the structural dynamics behind the asset. If you kind of miss that, you can lose a decade without realizing it, right? And that actually brings me to another example you shared with me, the Docklands apartment in Melbourne. I think it's 421 Docklands Drive, sold in 2014 for around 451,000, and 10 years later, the estimated value is still sitting roughly between 395,000 to 465. When you account for interest repayments, body corporate fees, property management fees, and the maintenance, it hasn't just delivered zero growth, it's likely been a slow, consistent loss, right? And what makes this really interesting is that the building looks really good, right? It's got waterfront lifestyle, easy access to the CBD, you got shopping centers, trams, cafes, everything you'd think would help values grow, right? But a decade later, the numbers haven't moved. And this isn't an isolated case. It's a pattern in certain high density pockets, right? So like, what's really driving that? Is it just the oversupply, or are there deeper structural issues at play when investors buy into this kind of developments?
Yeah, look, I think with Docklands, there's definitely been a number of cases down there similar to this. I think on a surface level, there's definitely a huge number of supply in that area. In terms of smaller apartments, there's multitude of developments going on in the area. I think there is a case of oversupply in that market with those units. There also is the value proposition and understanding what sort of people are buying the unit, what your appetite is from a sales side, what the holding costs are. There has been some extra changes down in Victoria as well with land tax. So, but in particular, those units, when they have a lot of amenities where it might be lifts, pools, gyms, saunas, things like that, there can be quite a high body corporate cost. But also looking at, there has been through a market there was COVID, but it's, looking at what you can buy in Melbourne as well, when you're comparing sort of 450, 500,000 where that apartment's going to grow. There are, other options within Melbourne, but also it is a very contracted sort of buyer that's looking at a one-bedroom apartment. It's not typically appealing to families. There's a certain, professional that's looking to buy that. Then also when you look at sort of a reduced demand from a buyer appetite perspective in terms of, single or couples, but not really a family because there's not that space. But then you flip it over to an investor lens, you've got high expenses, typically a large out of pocket. So there are a number of things at play, especially in Docklands. But I think in that case, there has been a lot of oversupply and there hasn't been a lot of growth in that particular part, those smaller apartments.
Yeah. What that Docklands example really shows, at least from my perspective, is that even a well-located, great-looking building won't grow if the fundamentals don't really support the scarcity, right? In suburbs like Docklands or even South Bank, you are, as you were saying, you are constantly competing with new towers, new releases, and a very investor-heavy market, right? When supply keeps increasing and the buyer base is mostly investors, you simply don't get the upward pressure in the price you see in owner-occupier driven suburbs. So now let's flip the script and look at completely different outcome. One that shows what happens when the fundamentals are working for you instead of against you, right? Take 63 Lakeview Drive in Deebing Heights, Queensland, right? Back in 2018, it was listed for about 445,000. Fast forward to today, like 2025, and it's now sitting at offers over 879,000. That's close to 100% increase in just 7 years. And this is a simple family-oriented suburb outside of Ipswich, not some speculative hotspot, right? And during the same period, the rent moved from about $340 a week to roughly $395 a week. So the owner wasn't just holding for growth, they were earning consistent income with low vacancy and strong tenant demand, right? So here you got two investors buying at a similar price point around similar timelines, but their outcome couldn't be more different, right? So what do you think really separates these two outcomes? And what's the thought process behind a genuinely smart acquisition versus one that just looks good on paper?
Yeah, I think especially in the initial stages, looking at, the big difference at play there is looking and understanding the cash flow side as well. So especially in a comparison with an apartment, where, you're typically understanding the out-of-pocket costs, understanding the potential growth, what the supply is looking like in the area, what DAs are going on in the particular suburb, what supply side integration you've got from developments. On the other side, from a Deebing Heights perspective, you're looking at a larger block of land. You're looking at typically your family home. You've got 4 bedrooms. You might have a study. You've got a spare room for people to come and visit. So the sort of appetite from a rental perspective is quite solid, but also the demand side for purchasing houses in that particular area in the Western Corridor of Brisbane has been quite high and continues to grow. So I think not only do you have a better appetite for purchases and capital growth side, typically your cash flow in an asset like that, looking at the yield comparisons between the two, your Deebing Heights will probably come out on top. And also you're looking at a quality asset which has got a lot of appetite. You've got good infrastructure. The price point at the time was, you're looking at getting into an area which has got potential growth. You've also got, typically the old saying of with land, you can't go out, but you can always go up. So you've got a demand for that block of land, which is obviously appreciating well. But you've also got a good appetite of potential people looking to sell it in that price point in Brisbane as well. So there's, on the acquisition side of the buyer side, it's really understanding what the value of a particular property is, because
Right.
I think it was last week I was sharing the example of if you're looking at a $900,000 purchase and you've got, potential growth rates of say 6 to 9%, if you pay $50,000, $60,000, $70,000 over the purchase price or over what the value of the property is in the area, that is potentially, 12 to 18 months of equity you've got to claw back before you start getting that appreciation of growth. So, it'd be interesting to sort of dissect, and maybe that's something we can look at, in our next catch up, is looking at, with that apartment at the time of purchase, what is the value of those assets in the area, outside high development areas. So, you've got some neighbouring suburbs, closer in or just on the other side of the city in Melbourne, like Toorak and areas like that, Carlton even on the north side, and really understanding what the value of a 1-bedroom unit was in comparison to the purchase of the low 400s. So it's really important to understand what comparable sales are, what is the true value of a property, rather than just taking, an off-the-plan brochure or something like that. Is really dissecting the value proposition of it and understanding how that property fits into your personal circumstances.
Yeah, I completely sort of agree with you. Deebing Heights has real sort of pressure behind it, right? You got obviously population growth, strong owner-occupiers driving the demand, and again, limited sort of new land coming to the market. And when those elements kind of line up, prices don't need any hype to sort of up, right? Whereas in high density apartment markets, the fundamentals run in the opposite direction, right? So there's basically too much supply, many investors, and not enough scarcity, right? And without that, that pressure, growth essentially kind of really stalls, right? So two people can spend roughly the same amount in the same year, but end up in two completely different financial realities, right? It always comes back to whether the asset has genuine long-term fundamentals behind it, right? And I think this really gets to the heart of what we talk about all the time: the difference between owning a property and building wealth through property, right? Because for most Australians, buying a home or investing in property isn't just another transaction; it's the biggest financial decision they will ever make, right? Yet so many people approach it like a one-off purchase instead of a long-term strategy that compounds over time, right? So, mate, if you had to give 3 pieces of advice to someone watching this right now, someone who wants to buy smart in whatever the time that we have left in 2025 or in 2026, what would you tell them to focus on first?
Yes, look, I think it's hard to bring it down into 3 points, but really what I'd look at doing, like our process and what we try and follow and execute, is really understanding what your borrowing capacity is, what your affordability piece is. So understanding, from that, I'll just use an example of from 1,000 purchase price, what are different properties in different areas give you in terms of an ongoing cash flow?
Yeah.
Once you develop your purchase, so understand your purchase price. And my second point would be understand the cash flow of property investment. Yep. So make sure you understand the rental returns, the interest costs, the property management fees, body corporate fees if they're applicable. So really understand your affordability and your cash flow. The third piece will be understanding value and market value of properties. I think it's, the most important thing is buying property well.
Yeah.
On day one, the better you buy it, the quicker you're going to make growth. So don't just make a jump and buy in an area because someone told you so. Really understanding what's the median price, what comparable properties are selling for. So in a summary, it would be understanding your borrowing capacity well, understanding the cash flow in your position, and third is buying well and understanding the market value in particular areas.
Awesome. Yeah. And I think the biggest shift people can make is to stop thinking in terms of buying a property and start thinking in terms of building a portfolio, right? Because once you take the long view, the decision making becomes much clearer, right? Once people start thinking that way, not emotionally, not reactively, but strategically, the outcome becomes very different over the next 10 to 15 years time frame, right? This is why conversations like this are so important, because it's not about predicting where prices will go or trying to time the market. It's about being prepared no matter what the market does, right? And that's what FPW was built around, right? Connecting finance, property, and wealth into one clear strategy. So whether you are refinancing or buying your first investment property or planning your next move, the key is always to sort of buy right, structure right, and think long term. So yeah, that's about it. Okay, that's a wrap for today. But do you have any last thoughts that you want to put out there, mate?
Yeah, I think that the most important thing is really understanding what each property is going to do for you in your circumstances. Yeah, different suburbs, different types of property, different land sizes, newer property, older property, they all have different mechanics around them. And, one suburb to the next can have different rental yields, different purchase prices and return on your money. So I think it's a case of really understanding what's going to fit into your circumstances and then building a plan around it. It's not every property's right for every person, and it's really making a clear game plan, working out what your goals are, and then working back and implementing the right asset for each point in your retirement plan.
Awesome, mate. That's a great insight. Thank you, and we'll see you next week with another one of these. Awesome.